Inflation is still hot, but with signs of improvement. Ukraine is still at war and affecting energy and food prices. Talk of recession is heating up. Stock and bond markets continue to test investor discipline. And should the Fed pull off the Band-Aid quickly or slowly? How long do bear markets typically last? That and more in this quarter's quarterly context webinar. Watch to stay relaxed by staying informed and remain current about things that actually matter to staying focused on your long-term goals and strategies. Welcome to this quarter's webinar. WealthStep is an online financial guide to help people in 401k plans and others make smart decisions about how much money they need to retire and how much to save and invest to get there. These webinars are designed to make economic and other information approachable, high-level perspective regarding the economy, markets, investor behavior patterns, and other elements to help you stay calm and make smart ongoing decisions. These recordings will also be posted on the blog at wealthstep.com. Please pass it on to people to help them achieve their retirement readiness as well. So what is WealthStep? Again, it's all about helping people better understand how to aim, save, and invest. We'll talk about that a little more later as well. What's key at the very top level in all environments is to stay focused on what matters. There's a cross-section of what matters overlaps with what you can control. That's the key area to pay attention to. You can't control what markets do. You can't control what the economy does. You can control how you react to it. And having an arrangement or an outline of your short-term and long-term goals and what's really required versus what's desired, as outlined in this image here, you could print this out or draw this out on a piece of paper, scratch down your ideas there and keep an eye on that, and that can help you prioritize and stay focused on what's important. So you want to define the goals, save consistently, invest by life stage, not by just jumping around or guessing or when you're worried. Be globally diversified and especially stay focused on sticking with your investment strategy through dips if you've picked a strategy that fits your life stage. Recent news always has things that move the market around a little bit. That's just always the case. In this case, recently it's been about inflation, about US overall growth cooling, questions about whether or not there will be a recession, mortgage rates going up, the Fed raising rates to try and rein in that inflation I mentioned a moment ago. And all of that has caused stocks and bonds to continue to be pretty bumpy, but nothing that's really out of the ordinary relative to long-term investment cycles. Markets tend to go up and down and be bumpy along the way, and the key thing is to stick with it to capture the returns when things recover. Nobody can guess when they're going to drop, nor when they will rise, and if you miss the rise by trying to miss a drop, that's when people tend to end up in giving up a lot of long-term growth that way. So the Fed raised interest rates 3 times by 0.75% in the last year. That has been making markets bumpy and nervous. It makes the cost of borrowing go up. That makes it more expensive for companies to run their businesses. It makes it more expensive for people to get mortgages. And that therefore then also cools the economy, tends to cause stocks and stock markets to cool. And it also negatively affects bonds because new bonds that are coming out at higher rates are more attractive than existing bonds or at lower rates. So those lower rate bonds tend to have their prices drop somewhat. Inflation is improving a little bit recently, but still relatively high. But over the next year, a couple of years, it's expected that it will come back down to the 2 to 3% range. Stock markets have been again, very bumpy, the dollar strong, and unemployment, interestingly, despite the talk of recession, remains pretty strong at only 3.5%. Now, this raising of rates, if that leads to a more recessionary environment by cooling the economy, that will likely lead to higher unemployment levels. Overall stock markets, again, pretty bumpy. down somewhere between 4 to 12% for the quarter, and bonds down 2 to 5%. For the year, bonds were unusually weak, down about 15% in the U.S. and about 10% abroad without adjusting for currency effects. U.S. stock market down about 18%, international stocks down 24, emerging stocks down 28, and so forth. So a pretty bumpy red year, but don't let that throw you off, because notice that the 5 and 10-year numbers are still very strong. So if you've been investing consistently over time, you are still getting this average return, and that is above the long-term averages. And if you write out these bad returns, you will also get higher returns in the future. So how long will that take? Nobody knows exactly. Recessions are not predictable, but when economists are finally very clear that there is a recession, you're usually already partway through it, and by that time, the bottom of the stock market has usually already happened. So, all this talk of recession doesn't necessarily mean that the stock market will be down forever. It may, once people are clear about it, the worst may already be done. So keep that in mind. That gives reasons for optimism. That said, markets are tough. It's not easy to be patient, but it's very, very important for the long run growth and return averages. The average down market, or significant down market, which oftentimes referred to as a bear market, is about a 33% drop. And it usually, on average, lasts about 14 months. Currently, it's been only 9 months, and it's down 23, 24%, depending on the time period here. So not as bad as the average. It could get a little worse before it gets better, but keep that in mind, how normal these drops are. And you have to get through the drops and be ready and stay invested in order to capture the upside when those upsides do happen, and they will happen. What kind of return will it take to get back to the top of the market? Well, first of all, remember the last top of the market we had at the end of 2021 may have been inflated and somewhat artificially high because of so much government stimulus that really boosted those markets. That's part of why markets are cooling now. It got a little bit ahead of itself, and now it's coming actually more to a normal level. Doesn't feel like that because a lot of people only think about those drops relative to the high. But anyway, the point here is that when we get back to the top, that should be hopefully a more normal top rather than an inflated top, which would actually at some level mean we were ahead of the past top on a valuation basis. That may be a little confusing, but the point here is just getting partially towards the top would be a big win. And if it did get to the full top, it would take about 36% return if it happened in 1 year, about 18% per year over 2 years, 12% per year over 3 years, and so forth. So not impossible to imagine scenarios where those things could happen and get back to a stronger return environment. But we will all need to be patient. How long do bear markets last, and how far do they drop? Well, it can be, historically pretty significant drops in some cases. You can see that it varies between 20 to about 60%. And how long they last can range from a month to upwards of 60 months. So a lot of variability there, and this is just may help you feel a little better knowing that it's past downturns have in some cases been a lot worse and had full recovery. If we look at the last 10 years of US stock returns and the last 10 years of international stock returns, what's interesting to see is that the averages here, if we average this out, are still ahead of those long-term returns, and they're ahead of projected returns. So that includes the current weak markets. So if you're part of these weak markets are happening as part of your long-term experience, remember, this is what if you've been a disciplined investor, something like this is what you've actually experienced in the stock portion of your portfolio. So keep that in mind. It's not just the downturn, it's all the stuff that has happened before that is part of your long-term return. Another way to think about that is if you see this blue line, this is a sample 100% stock portfolio, gradually worked its way up a little bit higher than average returns for a number of years. And then after the COVID dip, had a big spike upward with much higher than normal returns, and then it cooled down. So in many ways, you can think of that little mountain at the top there as being excess returns that were higher than they should have been. And if you cut that mountain off and draw a straight line, that gets us to where we are now. And that is roughly in line with a more normal pattern and would have been about a 7% average annualized return over the last 13 or 14 years, which is would still be pretty good. So you can say if you've been a long-term disciplined investor, where you are now is still a good place in terms of reasonably strong long-term returns, and projected returns are almost exactly that over this time period. So right on track, and you can think of this excess returns as maybe it shouldn't have gone that high, so now we're just getting more back to normal. That may help you think about these things. So should the Fed continue pulling rates up to try to control inflation? Pull that Band-Aid off fast, or should they let it happen slowly and do more, kind of wait and see what happens? We agree with the Fed's approach that doing it more quickly is more effective, and it reduces future uncertainty. It creates more discomfort and more weak short-term economy elements and weaker stock and bond returns in the short run, but it should improve and reduce risk of the economy and the stock and bond markets in the future. So yes, a faster Band-Aid in this kind of case is better. And remember that we're coming off a period where there was a lot of government stimulus to try to prevent a depression after the global financial crisis of 2008 and after the COVID dip of 2020. It would have been much worse to have no action, no stimulus, and have one or two depressions. Depressions tend to last a lot longer. They're a lot harder to get out of. They do a lot more damage to the economy, a lot more damage to people, a lot more damage to jobs. And a lot more damage to stock markets. So uncomfortable currently, but a much better scenario for the long run. So the Fed is raising rates to control inflation. What people believe about inflation actually affects inflation. So when people know that the Fed is taking it seriously, that can improve consumer behavior, which can improve the economy a little bit. There is some good news, a few different areas. This is not a fundamental financial crisis situation like the global financial crisis was. There are external elements that should be, will be temporary. It's just a matter of how long. The supply chain backups are starting to improve in some areas. The Ukraine-Russia war impact on energy prices and food prices, and therefore inflation. We hope that doesn't last too long for the sake of all of those involved and for broader peace efforts, and as well as the economy. There are other dynamics as well. If you look at those long-term averages, you're still ahead of the game if you've been a disciplined investor. And if you have a portfolio that's automatically rebalanced, like the portfolios in the 401k plans that where WealthStep is used, automatically rebalanced portfolios, which systematically buys low and sells high as part of keeping the portfolio in check with getting back to the intended stock bond mix for your stage of life. So there's a number of good things to think about there. Number of silver linings around this weak market. COVID has continued to improve. We're hoping this is waning into an environment where it may just be part of the normal flu season and flu vaccines. And maybe the biggest positive chart we can show is right up here in the upper right, where you can see the average number of deaths has come down to a level that hasn't been seen since the very, very beginning of the pandemic. So while COVID is out there and people are catching it, people who have greater immunity, have had vaccines, the average deaths are going down, and that means it is normalizing and will have less, therefore, of a significant impact on economies moving forward, whereas it's created a big uncertainty in the past and has definitely impacted the economy globally. Inflation, as mentioned, continues to be high. There are some parts of inflation and the way it's measured that have already started to come down. lumber is way down, apparel is down, electronic prices are down. So as that starts to happen, and as demand and prices and supply chain and some other factors start to stabilize, that is why the Federal Reserve believes that inflation will be more normal next year and even lower in subsequent years. As rates go up, that can create some short-term bumps, as mentioned. But notice that we've come out of an ultra low, almost 0% federal interest rate. That was part of that major stimulation program, big stimulus. But now rates are actually more normal relative to long-term history, still low relative to long-term history. In fact, it's uncomfortable to raise rates because of the short-term impact, but we're getting to a more normal environment in a number of ways. As rates rise, bond markets cool. This is the 70s, the last time there was a more, relatively significant increase in rates to try and control inflation. Now again, trying to control inflation, and bonds have dropped even further, but it won't stay that way forever. And as higher yielding bonds from the higher rates come onto the market and into portfolios, that raises the long-term average return. So there's another silver lining. Stock market valuations. It shows you a chart over time. Were very cheap in the global financial crisis, relatively cheap during the COVID dip, and now they're at a relatively cheap place again. Usually when stock prices are below average in terms of market valuation, that tends to just precede stronger returns. Now, it may take a little while to get there, but a lot of that correction has already happened. So that's another silver lining. Volatility levels are higher than they have been in a while, but still not dramatically higher than long-term averages. So a pretty normal situation in a lot of ways, even if it feels unusual right now. Some people have noticed that international stocks and bonds have had weak returns. That is in great part because for some time period now, because of the US dollar being so strong. But in the long run, the dollar and foreign currencies tend to take turns, and therefore, whether stocks and bonds from the US or from other countries tend to be strong or weak, tend to take turns over time. We've been in about a 10-year period where the US stocks and bonds have been strong. The prior 10-year period was considerably stronger for international. Some would project, given that international stocks are more attractively valued now, we might be headed and are likely headed towards a cycle where international will pay off. So if some people are asking, hey, why is that international mutual fund inside of my diversified portfolio? Well, there's a reason in the long run. We appreciate you being here. We hope this was helpful. Our goal is to help you achieve what matters by maintaining perspective to make smart, short, and long-term decisions.